All right, let's talk about your money. Today, we're pulling back the curtain on two huge secrets about what happens to your cash in the bank. Things that are quietly shaping your financial life literally every single day. Let's dive in.
So, let me ask you something. When you put your money in the bank, where does it actually go? Seriously, think about it. If you're imagining this giant vault, like in the movies, well, that's not even close to the whole story.
And that right there brings us to our first big secret. Your money, it basically leads a double life. The second you make that deposit, it starts this whole other journey that most of us never even think about. But get this, it's a journey that's absolutely critical to how our entire economy works. Yeah, see, here's the thing most of us get wrong. We think of a bank as just a storage locker for our money, right? A safe place. But the reality is so much more active than that. Your money isn't just sitting there collecting dust. Oh no, it is being put to work. So how is it put to work? Well, it's all about what the source material for this explainer calls the bank's lending machine. And it's a really powerful idea. Think of it like this. Your deposit is like the first little seed that lets the bank create this huge ripple effect of new loans and, in a way, new money all across the economy.
Okay, so the fancy name for this whole machine is fractional reserve banking. But the idea is actually pretty simple. Banks only have to keep a tiny little fraction of your deposit on hand. That's the reserve. And the rest, they can lend it out. So here's the mind-blowing part. The vast majority of your money isn't even in the bank. It's out there somewhere else.
Let's make this real. Imagine you deposit $1,000. The bank, by law, might only have to hold on to, say, 100 of that. So what do they do with the other 900? They lend it out to someone else. And then that person takes the $900 and deposits it in their bank. And guess what? The cycle starts all over again. That bank keeps $90 and lends out $810. It just keeps going and going, multiplying your original $1,000 over and over throughout the economy. It's pretty wild. And this right here, this is how that lending machine makes banks so much money. What you're looking at is the interest rate spread. So on one hand, the bank might pay you practically nothing for your savings, like a measly 0.4%. But on the other hand, the loans they're making with your money, they're charging something like 7.5% interest on those. That huge gap, that's the engine. That's how they make their profit. Okay, so secret number one is that your money is busy making the bank a lot of money. Got it? But there's a second secret, and this one's a bit sneakier. It's a force that affects every single dollar you own, whether it's in an account or stuffed under your mattress. Let's call it the invisible shrinking money. So you think your money is just sitting there, all safe and sound, right? Well, its actual value is anything but stable. There's this invisible force just constantly at work, changing how much stuff you can actually buy with it. And this gets to something we've all felt, right? Why does $100 today feel like it buys so much less than it used to? The answer is all about a concept called purchasing power. It's really simple. It's just how much stuff you can buy with your money. And as you've probably guessed, that power is definitely not fixed. And that invisible force, it has a name you've for sure heard before: inflation. All inflation really is the speed at which prices for everything, gas, groceries, all of it go up. And when prices go up, the purchasing power of your dollar goes down. Simple as that. We usually measure it with something called the Consumer Price Index, or CPI, which just keeps track of all those price changes. Okay, now this is where that abstract idea gets really, really real. Just look at this. In 1990, $100 could get you a full cart of groceries. Today, maybe a few bags. 80 gallons of gas back then is now just 25. The number on the bill is the same, it's still $100, but what it can actually do for you, its power, has just completely faded. In fact, the source material we're looking at uses some pretty intense language for this. It calls inflation the invisible tax destroying your savings. And that's such a great way to put it, isn't it? Because just like a tax, it's taking away from your wealth, but you never see it come out of your account. It's silent. All right, so let's put the two pieces of the puzzle together. This is where it gets really interesting. On one side, you have the bank using your money in its lending machine to make great returns for itself. And at the exact same time, the value of the money you have just sitting in that account is being eaten away by inflation. It's like this powerful 1-2 punch aimed right at your savings. So what's the bottom line here? What do you really need to remember? First, your bank isn't a piggy bank, it's a lending machine. Second, a huge chunk of their profit comes from that massive gap between what they pay you and what they charge for loans. Third, inflation is always there, silently making your cash worth less and less. And finally, and this is the most important part, this isn't about being scared. Knowing this stuff is the absolute first step to actually protecting and growing your wealth in the long run.
And all of this leaves us with one last big question, a really empowering one, actually. Now that you know these two forces are always at work, how do you make your money work as hard for you as it's been working for the bank? Because thinking about the answer to that question, well, that's where the real journey begins.